Welcome, mobile home park investors, to the latest edition of the Mobile Home Park Desktop, where I bring you news, analysis, insights, and tips on mobile home park investing from my desktop. So today we're going to do things a little bit differently. One request that I often get from people are for tools that I use, some of the tools that I use in order to evaluate deals. So today I want to introduce you to a tool that I put together. And this is a tool that evaluates how your year one cash on cash returns will be affected by the cap rate that you pay or by the loan terms that you're paying. All right, so let's go ahead and let's dive into this sheet. And so what this sheet does is it takes the cap rate and the loan terms and your interest rate and your overall capital needs, and it uses that to estimate what your year one cash on cash or yield on capital return percentage is going to look like. So I'll just walk you through this, and as I walk through it, I'll try to explain it as best as I can. So let's start here with a purchase price. Let's say that your purchase price is $3 million. And let's say that with the CapEx and closing and reserves, you're going to need to bring about another $90,000 to the table in order to close this. So that's 3%. Let's say that you feel pretty comfortable about getting a 75% loan to value on this particular property. So that's about a $2.25 million loan. So what we know now is that we're going to need to bring about $840,000 to the table in order to close this. So what we have to figure out is, what does this $3 million represent in terms of a cap rate? So let's say that you found out that this was $3 million was based on a 7 cap, right? So if it's a 7 cap on $3 million, that means that our NOI for year one is going to be $210,000. That's what we're estimating it to be. If it were, let's say it were an 8 cap, well, that means that our year one NOI would be estimated to be about $240,000. Okay. So as you change your cap rate, what you're essentially saying is what you think the year one NOI is going to look like, right? So let's keep it at $210,000, and let's keep our interest rate at 4%. And let's say that amortization for this particular loan is 20 years. So we have 75% LTV on a 4% interest rate over a 20-year period. Okay. So now we take a look at our NOI. Our NOI for year one is $210,000. We just take the overall purchase price and we multiply it by the cap rate, and that's how we get our NOI. Then we have our debt service payment, which is a PMT formula, which is Excel's way of figuring out what your annual or your monthly payment is going to be. I just multiplied that by 12. We have a debt service coverage ratio of 1.28. So usually banks want to see around 1.2 or above in order for them to be comfortable lending on the deal. So that passes sort of the first metric. And we see a breakdown here of your debt service. Your debt service for year one is going to be about $88,000 in interest payments and about $74,979 in terms of principal paydown. If you put those together, you could take a look here at your sub column. It should always equal your total debt service, because your debt service for year one is all of your interest and all of your principal paydown. So that means if you subtract out the NOI, if you subtract out the debt service from the NOI, you get your cash flow. So your cash flow is going to be about $46,385. Let's take a look at what that means. So on an unlevered basis, that means if you paid for this all in cash, if you paid the $3,090,000 all in cash, your cash on cash for year one, your unlevered yield on capital would be 6.8%. Your year one yield on capital, cash on cash, would be 5.52%. So now that might seem counterintuitive to some people. They're like, well, why? I'm getting a loan. Why is my cash on cash lower? Shouldn't I be getting a higher cash on cash? It depends on how you're looking at cash on cash. If you're looking at purely as cash flow that's coming into your bank account from this investment, then yes, your cash on cash will actually be lower if you use a loan in order to do this. You'll have to use a whole lot less money in order to close the deal, but your cash on cash will actually be lower. But the thing is, here's the the thing that you're not accounting for is how do you want to count your principal pay down? Because in addition to paying the interest, so this is your cost of money, you're also paying down the loan, right? So you've also paid down $75,000 in principal payments. So if you want to see what you were getting, if you want to include the principal payment as well as your NOI in terms of, the principal payment as well as your cash flow, you want to calculate what all of this is altogether. Another way to look at this is to just assume, to conceptualize that this is an interest-only bank payment. Because, okay. By putting 1,000 here, I'm essentially making this or converting this into an interest-only payment. So now my debt service is $90,000. The PMT disappears, and you're counting your cash flow plus your PMT. So now you can see how the yield on capital changes to a 14% yield on capital. So when it's a 20-year AM, remember that a large part of the debt service is going to paying down the principal payment. So let's say that we change this to a 30-year AM. Well, now your yield on capital let me just put here levered to make it clearer. Your levered yield on capital will actually be a lot better now because you're spreading out the payments over a longer period of time, and less of your payment is going toward paying down your principal. So this is a good way, kind of like an overview. It's a way to kind of take a look at a deal from a high level perspective, and you get to play around with some of your cap rate and your interest rate assumptions, as well as how much capital you're going to need, because these are the things that are really going to drive your cash on cash yield. It's how much extra capital are you going to have to bring, how much of a loan are you going to be able to get from the bank, what is your interest rate and your amortization, and what is your cap rate going to be for year one. And your cap rate, remember, is an approximation of your year one NOI divided by how much you're paying for it. So let's say that in this situation, let's change the cap rate to let's just say it's an 8% cap rate. So now you can see that your returns are going to start getting stronger, because with an 8% cap rate on a $3 million purchase, the assumption is you're going to get about $240,000 of NOI. Before, when it was a 7 cap, you assumed that you would get about $210,000 in NOI, and you can see that your returns here are also changing as well. The thing that this calculator will help you do is it'll help you take a look at your refi value. So if you're putting in $3,090,000 in total capital into this deal, you're actually only putting in $840,000. But let's say you want to refinance out and you want to pay off your loan, you want to pay off all the equity that was put into the deal, then you'll need about $3,090,000 worth of capital. Now it'll fluctuate a little bit because you'll also be paying down the principal, so your loan is going to be shrinking a little bit. But you're also going to have to pay for loan fees, refinance fees, and all that other stuff as well. So we'll just kind of use $3,090,000 as an approximation of how much capital you're going to need in order to completely 100% get out of this deal, the cash out refi, right? So in this case, what we do is we take that $3,090,000, we divide it by the LTV of 75%. So we'll think that in order for us to cash, when we try to refi out of the deal, the bank will give us a 75% loan to value, which means that if the value has to be $4.1 million in order for us to achieve a $3 million cash out refi, $3,090,000 cash out refi. And how do I do that? How do I calculate that? All I do is I just calculate the total capital that we need, and I divide it by the loan to value. And by doing that, we realize that our refi value has to be, when we go to refi this thing, our value has to be about $4.1 million. Well, how do we achieve $4.1 million, $4.12 million in total value? Well, we have to make an assumption. We'll just assume for now that our cap rate that we purchase at, our 7 cap, is also our refi cap rate. Okay. So if we take that number and we multiply it by the refi value of $4.12 million, that means that our target NOI has to be $288,400. So when we're doing this quick analysis of this deal and we're looking at all the parameters, what we know is we know that if we can get to $210,000 in that we're, in year one NOI or the trailing 12 NOI, however the cap rate was calculated, if we can get that $210,000 and we can increase it to $288,000. So if we can increase by 37%, this is NOI growth. If we can have 37% NOI growth, if we can get from 210,000 to 88,400 in NOI growth, then the value of this will be $4.12 million, and we'll be able to 100% cash out refi. So that's what a lot of people will analyze when they're trying to make a decision on whether or not to go forward with a purchase, especially if it's kind of a value add deal. They might not be as concerned with the year one cash on cash yield. What they'll try to be conceptualizing is how quickly they can add value and be able to refinance and pull out all of their cash and redeploy it into the next deal. So this is a cool tool. It helps you to kind of quickly take a look at deals and kind of decide how the deal looks from a 50,000 foot view. Obviously, when if you actually go through with the purchase, you're gonna have to really dive into the numbers and make sure that all your numbers make sense. But from a kind of a big picture perspective, you can kind of see what the relationship is between your cap rate and your loan terms. So take a look here. So you have a 7% cap rate, you have a 4% interest rate, you have a 30-year AM, you have $210,000 NOI. We're going to assume that it's 3% reserves and 75% LTV. And take a look here. Your year one levered yield on capital, your year one levered means with a loan, yield on capital is going to be about 9.65%. Here's the thing, it won't matter even if you're paying $20 million for this deal. Oh, whoops, let me add another zero. $20 million for this deal. Oh. Your yield on capital is going to be, your levered yield on capital is going to be exactly the same. If you're paying $100,000 for this deal, 0, 0, 0. It's still going to be 9.65%. So what's that tell you? It helps you to conceptualize that really what matters is your cap rate, your cost of money, your interest rate, your amortization, everything else, and your relative the amount of money that you can borrow and how much extra money you have to bring to the closing. Because as long as those numbers stay the same, then your yield on capital is always going to be the same. It's always going to be the same. It doesn't matter. It won't change with the amount or size of the deal. Your yield on capital is going to be exactly the same. So let me show you one last thing here, and this is the big chart here. So what I've done here is assuming all of these things, a $3 million purchase price, and an extra 3% for closing costs, capex, and reserves. What this chart does is it takes all the different cap rates. So if this $3 million in purchase price represents a 5 cap or a 5.25 cap or a 5.5 cap or 5.75% cap rate, right? If you're paying 5.75% cap rate on this $3 million, or if you're paying a 7 cap on this $3 million, what it will do is it'll show you the relationship between the cap rate and the interest rate. So the interest rate here, if the interest rate is 3.5, if it's 4%, if it's 4.5%, you can kind of see. So if you're buying something at a 5 cap for $3 million with 3% in closing cost, if that's what your purchase metrics are, and you're buying it at a 5 cap and you're getting a 5% interest on a 30-year AM, then your cash on cash yield will be about 0.6% return. So what you can do with this chart is it can kind of help you to find the intersection of return that you want. So I have it automatically turn green when it's double digits. Trying to achieve year one double-digit returns is pretty difficult to do, but I just wanted to find some metric to sort of separate out some of these numbers. So if you had a 6.5, if you're purchasing a 6.5 cap at, let's say, 4% interest on a 30-year AM, then your return on your capital is going to be about 7.87% in year one if you also had a 3% in closing costs. So if you had 10% in closing costs, then you see your numbers are going to start to change again. Now, if you purchase at a 6.5% at a 4% interest rate over a 30-year term, if you're purchasing at a 6 cap, then your year one yield on capital would be about 4.87%. So what I like about this tool is it not only does it help you to kind of quickly analyze a deal and kind of quickly size up a deal and sort of think through what you want to pay for this deal, what sort of cap rate makes sense as compared to your interest rate, but it also just, I think it's a cool tool to help me conceptualize, to help me think through how cap rate, how interest rates, how closing costs, how all of it relates together, how your loan to value, how it all kind of relates together. So in a use case scenario, let's say that you have 2 different loan terms that you're being pitched. Maybe one banker is telling you that they'll do 4.5, but it's going to be over 4%, but it's going to be over a 25-year AM. Another banker is telling you it's going to be 4.25. Whoops. So I got to use the pull down. 4.25, but it's going to be over, a 30-year AM. You could sort of see how this affects your yield on capital. Someone else is saying, hey, look, we'll give you 4.75, but we're going to give you interest only. You could start to play around, or, hey, we're going to give you 4.7, we're going to give you 5%, or let's say we're going to give you 3.5%. We're going to do 30-year AM, but we're only going to give you a 65% LTV, right? So now you could start to see how all of this stuff is related, how it affects your yield on capital. You could also play around, as I showed you before, if you assumed that the principal was actually counting towards your return. If you want to count your principal pay down as part of your return, you could either add up this 104,924 plus the 37,423, and then you could divide that by your equity, or you could just plug in 1,000, and it should sort of approximate what that return looks like. All right, guys. Well, I hope you find this tool interesting. I know this is this one was very data driven, lots of hardcore numbers. I have these little, I put these things in, so the cap rates actually can go a lot lower than 5 caps. If you're looking at 3 cap parks, I don't know who's looking at 3 caps parks, but if you are, it can go all the way to 3 caps. And if you have some access to really, really good financing terms, you could also toggle. You can open up all the way down to 2% interest rates. So I know it was a lot of math, a lot of finance here. But I think what the good thing about having a calculator like this is you can just play around with numbers, and it can just kind of give you a better sense for how your returns are affected by how much you pay, by your cap rate, by your interest rate, by the amount of loan size that you get, by how much extra capital you have to bring to the deal. All these different factors, you can just take a look and play around until you start to get a real good firm grasp of what type of deals might fit you the best. All right, let me know if you have any questions. This was a hard one for me to explain, so I hope everything was clear. But if you have any questions, be sure to drop a comment in the YouTube, or wherever you see this on social media. Go ahead and drop a comment. I'll do my best to explain. All right, thank you very much.